Since the Great Depression in 1930, 2022 has been the worst year for investing in stocks. Not everyone is optimistic, and some believe things will only get worse. The British pound, for instance, recently hit a record low. In a year when bonds are supposed to be the safest investments, bond prices plummeted to their lowest level since 1949. Also, the Federal Reserve is currently raising interest rates at a speed higher than any time in the past. Furthermore, legislation is pending in Congress that would enact a trading ban, restricting the markets for certain securities. That's why, in this video, we are going to take a look at this terrible news and what this means for investors. Hi everyone, this is Fred. Don't forget to smash the like button below and subscribe to Investing Wise Academy. To begin, we need to discuss the current situation because all of these chaos can be summed up in just two words: interest rates. This would be carefully controlled in a well-functioning market to maintain low unemployment and consistent wages for consumers. However, when inflation is near a record high and prices are rising uncontrollably, there is no choice but to shut down the money printer, increase interest rates, and hope for the best. Aside from the stagflation era of the 1970s, interest rates have risen more quickly and to a higher level than any other time in history. You can see this reflected in the price every time you log into your stock account and start sniffling. Most people also don't know that the Federal Reserve is reducing its balance sheet even as it raises interest rates. This includes the sales of mortgage-backed securities, corporate debt, and other investments, which is adding further downward pressure to the market. And if you're still confused, let me walk you through it with a very basic example. The Federal Reserve stepped in to purchase corporate bonds and mortgages during the 2020 pandemic, and their goal was to prevent a further decline in prices and a subsequent collapse in the market. It's the same as if a whale came in and bought all the shares in the company, causing the price to rise and drawing in the commoners. However, these led to their balance sheet expanding rapidly. That can't go on forever. Sadly, sales have started happening without anyone noticing. One method is called a balance sheet runoff, which involves the repayment of debt rather than the reinvested proceeds. They would remove the money from circulation by destroying it. The Federal Reserve must be extremely cautious not to offload more than the market can absorb, just as a seller could dump too much stock and crash the price. According to one analyst, we live in a country with an experimental monetary policy. We have no idea how this situation will develop. This is why people hoard cash and government-backed treasury bonds, which pay nearly 4.5% risk-free for doing nothing. However, here's what you need to know about which investments will be most affected by the investment ban by Congress. This is the part that I found the most discouraging. The concept of buy the dip is the starting point from which everything else flows. The idea behind this is that no one can successfully time the market. Anything can happen, and it's better to invest regularly over the long term to benefit from the market. Even though the typical investor can't beat inflation over a 20-year time horizon, a study has shown that investing in the stock market is the best long-term strategy for building wealth. However, this doesn't mean that investors can't experience some discomfort in the short term if they buy the dip and the stock market continues to fall. And as I mentioned before, 2022 is shaping up to be the worst year for buying the dip in nearly a century. The Wall Street Journal reports that the S&P 500 has fallen 1.2% on average in the week following any one-day loss of at least 1% this year. And the last time this happened was in 1931. They continue by saying that many mistakenly pessimistic investors about the recent stock market rally were buying, and the dip ended up being a highly effective tactic. But in a well-functioning market, stock prices can stay low for months or even years without any indication that they will bounce back to their previous highs. This paints a very realistic picture that there will be years of losing money and entire decades where the stock market trades completely flat, and that this is entirely common. The market trades negatively 25% of the time, and the average decline of a bear market recession is 35% for 495 days. This has provided a fantastic buying opportunity for those who don't sit out of the market and continue investing as usual. Even if we take the most recent example of the peak of the dot-com bubble in 2000 and follow it through 2012, we see that the market was flat during that period. Using that scenario, you would have made a total of 4.66% over 12 years if you had only invested at the market's peak and never again. However, if dividends are factored in, your return increases dramatically to 32%. In contrast, if you consistently invested in the stock each month, regardless of its price, your cumulative return would increase to 24%, reaching 42% if you reinvest the dividends. So, are you getting it so far? Now, before we continue, I want you to think about trying our Super Thanks, wherein your comments will be highlighted, or you could also join our membership program. And now, let's go back. However, Congress has a slightly different view and is enacting a trading ban that is making its way through the system. And this is a problem that needs to be addressed. Most people have no idea this is happening. So here's what you need to know about the investing bill going through Congress. The Stock Act of 2012 is the initial catalyst for all of this. Lawmakers passed this measure to discourage insider trading. Therefore, they must make an open announcement whenever they or their spouse make a stock purchase or sale. If they invest more than $1,000, they have up to 30 days to report it, or 45 days if someone other than themselves or their spouse made the investment. Since we can all see what they are buying and selling, we can easily imitate their strategies. Naturally, the stock recommendations perform pretty well. Market Sentiment, a blog, compared the returns of over 10,000 stock trades totaling over $15,000 over 2 years to the weekly, monthly, and yearly returns of the S&P 500. And he discovered that after 1 month, their stock picks outperformed the S&P 500 by an average of 0.12 percentage points. After 4 months, by 1.34 percentage points, and after the experiment was complete, by nearly 6 percentage points. However, the plot thickens from here on out. The median disclosures were made by day 28, while the average was made by day 52, even though they have an average of 30 days to report each trade. Most people wait until the last minute to report stock trades, and those who do end up paying a $200 late fee, which is essentially nothing. However, if you just copy their trades, you would still be ahead of the market even with all of that on a 30-day delay. In other words, that's where the trouble starts. In the current system, elected officials are not restricted from making purchases or sales so long as they do not use confidential information for personal gain. On the other hand, the New York Times broke the news on September 13 that more than 1 in 5 lawmakers claim to have bought or sold stock between 2019 and 2021. 7 congressional committees allegedly provided information about the companies whose shares they disclosed buying or selling. For instance, Boeing stock was sold the day before a House committee released incriminating findings about the company's 737 MAX. Another instance of referencing the trading of cattle contracts at a time when the cattle market was being discussed. The third instance is the sale of Wells Fargo stock a few months before a dire warning was issued to the bank, which caused the stock price to plummet. When they dug deeper, they found that 97 representatives had been flagged. More than 3,700 trades made by lawmakers from both parties have been reported, and it is alleged that these trades pose potential conflicts of interest between their public duties and private finances. In addition, the New York Times isn't the only outlet looking into these claims. One Twitter user predicted which members of Congress would beat the market in 2021. Some of these lawmakers would even outperform Warren Buffett. Therefore, there is a proposal in the works to prohibit stock trading. All high-ranking officials would then be barred from the stock market, stock options, commodity futures, cryptocurrency investments, and short selling. It's also important to note that this has nothing to do with the partisan divide, as both the Democrats and the Republicans outperformed the market by nearly the same margin. This points to the problem being system-wide and requiring comprehensive solutions. So, what do you think of this investment ban for high-ranking officials? Will this change anything? Let me know what you think in the comments section below. And while you're at it, make sure to smash the like and subscribe buttons as well. Now, if you want to learn how to increase your income through stocks, make sure to click and watch this video right here. And that's the end of this video, guys. See you next time.